Hello, Midplains, and greetings from Chicago. It's a pleasure to be joining virtually the annual meeting again and how things have changed this year. There's really no ag market on earth that we can find that's been in a bearish trend since summer and on their own fundamentals. And that's part of, I think, what will make the next several months very special. There are no substitutes available in that sense. U.S. crops are still competitively priced despite current prices, and that's a nice place to be. And our insight really is that not only will we have tight stocks this year, that's pretty well known, but what will probably be very tight stocks next year, even assuming trend yield. Record yield, by far record yield is needed to really change or solve the supply problem. And that's not somewhere that we've been for several years. We'll have the opportunity to sell at higher prices. Revenue insurance guarantees will be helpful. And really, the market's tolerance to weather issues this year, unlike the last 5 or 6 years, is zero. And if nothing else, that's what I want you to take away from this. It will be a bumpier ride moving forward, but this volatility in the end, as always, will provide opportunity. So to jump right into 2021 grain market fundamentals, the world markets, of course, turned bullish in late summer, and this is following the trifecta of lost supply. Major yield loss in Europe, U.S. and Black Sea for corn, wheat, and oilseeds. And also in South America, we think. That's not been fully digested by the USDA and perhaps the market yet. And all crops have suffered losses. So it's not possible now to replace corn feeding with wheat feeding because those crops worldwide are also very tight. The markets worldwide cannot substitute rapeseed oil for soybean oil because those markets are all tight. So even with trend yield in 2021, grain balance sheets could tighten further on a major exporter basis. Demand growth is also occurring. To some extent, it will be about biofuels in the U.S. Just, on the margin, eliminating the small refinery waivers will help corn demand at least somewhat. Carbon becomes more important over the next 4 years at least, and so that we think bolsters the RFS and mandates more and more corn and soybean oil used in biofuel production. But really, the big driver has been China's herd hog expansion. So we knew this was coming, but it is happening based on the numbers that we get from reliable sources within China. And so far, that is important to us because China is not solving that issue by growing their own crops, rather on importing sizable tonnages of world corn, lots of sorghum, lots of soybeans to make soy meal, and even to some extent, they're starting to import ethanol. And that's all very good for the U.S. market. At the same time that we've lost crop, we're adding to demand, we're seeing these growing protectionist food policies. Russia has implemented a pretty sizable €50 per ton tax on its wheat exports starting in March. This floating tax, to some extent, probably continues on Russian grain exports into the new crop year. And there's very strong indications that Argentina will follow because of inflation, because of potential crop shortages this year. But really, more than anything, these are signals that these exporting countries are focusing more inward on their own supply rather than choosing to dominate world trade as they have done for the last couple of years. So to solve these issues is not going to take just 1 year. This is a multi-year bull market in global crops. It's very difficult to be bearish until we know that the supply problem has been solved, and that's only solved with record northern hemisphere crops, and that won't be known until late summer. And actually, we've learned from this year that you don't really know what final crop size is going to be until September or October. So we wait until then for a real bear market to resume, and any weather scare has an outsized market influence. We are at a point in the curve that even small changes in perceived U.S. or world supply have a very, very big impact on price. Big picture issues are also supportive. For the first time at this meeting in a couple of years, we are looking at a weaker dollar trend. And so we think moving forward, maybe the dollar is neutral, but the change from the last 12 months has taken incentive away from the farmer in South America and the Black Sea. Because of currency, they're no longer being incentivized as they were to expand production. And so as margins shrink, the incentive to continue to expand area and invest in technology will be eroding. Practically speaking, too, this does mean more inflow into raw materials. This shows the broad correlation over the last couple of decades between the U.S. dollar index and the basket of commodities in the U.S. And so as the basket of commodities starts to rise, we start to see more, index fund investment. And so those aren't market driving investors, but it does give us a pillar of demand or support. We have seen over the last several weeks that the index funds have put lots of new money into the ag space and the raw material space as a whole, and that doesn't go away until there are signs that that needs to change. But as inflation becomes the theme of 2021, I expect that money to stay in the ag space. Speaking of inflation long term, we are thinking that there's potential for it to be very, very good for the commodity markets for the next 12, 24 months. Oddly enough, COVID has triggered this need to produce nearly half of every dollar printed has been printed in the last 11 months. That's due to economic stimulus, and this is a proxy also for the world markets. The same is true in Europe, a lot of places in South America as well. Just printing money, stimulating the economy to maintain some semblance of welfare and well-being. That money is not moving around very much, though. And that's what's given us this sort of hiatus in economic growth. Demand for physical goods, stay-at-home purchases have been favored, but nothing else has been. So, return to, the velocity of money, return to something like 2009 is not expected at all. But even getting this back to pre-COVID levels, we have a record amount of dollars in the economy. Having those circulate at a faster rate, we think would be very, very good for a lot of things, including a lot of food products. And that working down the chain is very good for corn, soybeans, and wheat as it pertains to dairy products consumed, soybean oil and bakery consumption, etc. And in the physical cash market, it's not happening now. But the silver lining to that is it does come back in 2021, and the markets that we're seeing now are not based on physical demand for foodstuffs. Just thinking about the metaphor of in-restaurant breakfast dining nationwide or worldwide, and what that will do to the price of eggs, price of butter, dairy operation profitability. So none of that has happened yet, but it is forthcoming. And so that will be yet another pillar of demand in the physical cash market once it does come back. And we think there's a lot of pent-up demand and really interest, for myself personally especially, but to go to restaurants and to do things outside of the home. So this goes back to zero or even positive, again, we think in the second half of 2021, and that will have a big impact on the price of physical commodities once it does happen. For grain market specifically, this year has been initially defined by the loss of production, again, in all major exporting countries. And to put this into context, it is rivaling previous crippling drought years. So far, we have lost 54 million tons relative to initial estimates in May. We think this gets a little bigger, maybe adds 6 or 8 million tons to it as South American production is better digested. We're hearing very bad things about the early soybean harvest in central Brazil. Drought has returned to Argentina. But so this tells you that we're, moving towards the crippling drought of 2012 in terms of supply dislocation. And so, of course, tight old crop in stocks become lower new crop beginning stocks. And we're starting from a position in that we're not conducive to the return of a bearish market in the near or medium term. And how that's been impacted, how that's impacted the U.S. corn balance sheet is pretty dramatic. Over the summer, we were concerned that the U.S. farm economy would go through very, very dire period. And we saw a path towards the middle or end of late summer that corn in stocks would be 3.5 billion bushels. Fortunately, that was erased and it has been cut by more than 50%, and the USDA on Tuesday printed a number of 1.5 billion bushels. So that by itself is pretty supportive and validates current prices, but we think that this ultimately gets even smaller as the U.S. continues to be the dominant exporter of corn, and as South American crop loss forces even more exports to the U.S. in calendar year 2021. In soybeans, it's a similar trend, though it's been a more multi-year process. We've gone in soybean inventories from nearly 1 billion bushels to now just 120 million bushels officially. We're kind of outside of waiting for the USDA to tell us what soybean supply and demand is, though. It's more of a measure of determining the measure of rationing that's happening. The USDA has only printed soybean in stocks below 100 million bushels one time in the last couple of decades. And so they won't get there until they know it's happened, probably by the September stocks report. But 120 million bushels to us still seems too large, based on the pace of crush and exports. And so some measure of demand has to be destroyed, and it's clearly not happening now. We're still exporting much too many soybeans. There's really no incentive to slow down crush. Everyone's making money. And so this only gets solved by higher prices. And it's not a situation unique to the U.S. Again, I mentioned the lack of substitutes. We can pick really any commodity market in the world that shows a similar trend. So Malaysian palm oil supplies have gone from overabundant to very, very tight in a matter of 12 months. So this is comparable to about 42 cents per pound at the moment. So in that sense, U.S. soybean oil is now above palm oil, but really is not uncompetitively priced in the world market. Malaysian palm oil typically, and it's supposed to be the largest traded vegetable oil in the world, and it's typically the cheapest. But the cheapest vegetable oil in the world is trading at 40 cents or higher. That's telling us that if we need to slow soybean oil consumption, we need much higher prices than we're seeing now. And it's very difficult to ration food products. They're fairly inelastic. This is a very good source of calories, as is wheat. And so it'd be very difficult to convince the consumer to stop eating these cheap sources of calories. And as exciting as soybean and corn and Malaysian palm oil has been, the most bullish market, the winner so far this year, has been the sunseed oil market in Russia. So there's clearly a problem developing. And as it relates to us, this is nearly 60 cents per pound. So in that sense, soybean oil, where it is today, is fairly cheap. We're almost expecting an embargo on sunseed oil and sunseed exports from Russia based on their concern over inflation and just the need to end demand growth until that domestic stocks are adequate. The second place on this list of most bullish markets would be the cash sorghum market across the U.S. plains. So China is on pace to buy nearly all of our sorghum supplies at the cost of the domestic market. And so, China has bought a near record amount of sorghum so far, and that has forced the domestic market to slow feed use. Virtually no sorghum will be used for ethanol production moving forward. Clearly, that's because the price is so expensive, and this market is also buying for acres. So we think about the problems that need to be solved. We need more corn acres, definitely more soybean acres, but we've already planted more winter wheat. We'll be planting more sorghum. And so we're starting with a smaller pie to divide corn, soybean, and cotton acres from. And so that's been the issue. And again, why I mentioned that all crops have suffered losses and have tightened supply and demand is how does this problem get solved? And it's not a one-year issue. And so we're still bullish, even at current prices. It's going to be bumpier moving forward, but our balance sheet is much tighter than the USDA's, as of February 9th. And so our in-stocks are about 500 million bushels lower because we have a much higher export forecast. We think even the USDA's industrial use, ethanol use, is too high despite negative margins. Soybeans are similar. I mean, we're above and beyond predicting some kind of stocks to use ratio. This is what we think is the absolute bare minimum, but also what we're on pace to accomplish at the rate of current crush, current exports. Even residual use has not shown us any sign of providing a buffer against those two things. And so we do need these things to be realized in order to get new highs in the markets, but I'm going to tell you now why we think those will be happening. So like I mentioned before, China has been the new demand driver. Not as big as the biofuel boom in 2005 to 2010, but sort of towards that end of the spectrum. So they're clearly on pace to import a near record amount of feed products because of the hog herd expansion and the economic growth has resumed. In soybeans, we think that in the next year, imports will be 110 million tons. And so that demands higher production, not just in the U.S., but in South America. I mean, to turn bearish of soybeans at this point, we need record production in both hemispheres on a consistent basis based on China's need. We know China has opted for a long time not to grow its own soybeans, but rather rely on the imports. And so this is a trend that gets exacerbated. And most importantly, you can see that we had a blip from the trade war and maybe the conveniently timed swine flu, but we're back to seeing growth. And that's what's most important. So extrapolate this out for another 10 years and think about what kind of crops need to be grown in South America and in the U.S. and even in parts of Ukraine and Russia. We need all the soybean production that we can get because they're not going to stop buying these things. because they're incentivizing hog herd expansion and efficiency, and because they've lost so many animals over the last couple of years, the margin to produce pork is just incredible. And it's being exacerbated by these new loans, which essentially are free. You can put up your animals as collateral. And so that's been part of this thing to facilitate new expansion. We've all seen probably the high-tech multi-story buildings that they're using to produce pork and grow pigs. And none of this is going to slow down with current margins. And they are starting to accomplish their goals. And so, again, this is pretty reliable data, but as of September, 38 million head sow inventory. The target over the next 10 months is close to 45 million, but the rate of growth suggests that they will get there. To feed all those pigs, it takes a lot of feed. And we've seen this kind of match the expansion in hog numbers and pork production. And again, this is only going to be accomplished for the next 12 or 24 months by imports. And also, our theory, too, is that we think this has all been a function of gilt retention so far. And so they haven't really started to expand animal numbers in terms of piglets. And so if you multiply every animal that's there now and multiply it times 10 or 12 or something like that, then the need for Chinese feed production gets incredibly robust over the next 12 months. And so this is why the trade deal does help us, and that's partially why they started to buy U.S. supplies, soybeans and corn specifically, in late summer. But their need for feed is very real and does not go away in the next year. And so to that end, we have been exporting far too much of our bean supply, and we're getting to export too much of our corn supply. So this just tracks weekly export sales as a percent of final, or in the case of the current year, as a percent of the USDA's forecast. And this is updated to match the USDA's new export forecast, which they raised 20 million bushels in the February WASDE. It's still at a record amount. And so generally speaking, once the red line is outside of the yellow shaded area, exports are too low, and vice versa. But there's still nothing to suggest that we're really slowing down the pace of sales, and Brazil's really slow soybean harvest probably adds to old crop commitments over the next 4 to 6 weeks. And so mathematically, the USDA's forecast is still too low. To date, there's been no sign that crush is anywhere close to their annual forecast. So NOPA member crush is up 7% from a year ago. The USDA's forecast for the year is up 1.6%. We'll get a new number next week, but if this is at least 2% above last year, then the USDA's crush forecast is still too low. So this is not just an idea that we have that demand is exceeding the USDA's numbers. This is just simple arithmetic still at this point. And it's even more exacerbated, we think, in corn. And so after selling 230 million bushels of corn to China in the last 2 weeks on a known basis, 250 million bushels total, this is where we stand. So the USDA gave us a token increase in exports of 50 million bushels in the February WASDE, but this is still their export forecast, 2.6 billion bushels. It's still far too low, but we think up to 400 million bushels. Thursday's export sales report will probably show a number of 100 to 115 million bushels. So this just shows you the discrepancy in what needs to happen and what's happening. So in every week that the U.S. Export sales number is above, at this point, 13 million bushels, the average needed moving forward gets lowered even more. So we think by the middle of March, the U.S. export community only has to sell something like 10 to 12 million bushels per week to meet the USDA's forecast. And even in years that we weren't competitive in the world market, we would average sales of 20 to 25 million bushels from February to August. So extrapolating this out, this gets you to 3 billion bushels pretty easy, upwards of 3.2 to 3.3 million bushels if South American crop loss is confirmed. So that's, again, the arithmetic of corn exports. And we're seeing this reflected in the cash market. Basis is firm relative to history in most places, not some of the feeding centered areas, but especially along riverways that have any tie to the export market. The spot basis has been firm for a long time. This is in Peoria. We'll just pick a spot on the Illinois River. But it's the April and summer basis that's been most interesting, and has really exploded. I think there is a concern in the cash commodity community that will we have the supply, and how do we get it from the farmer, given that normal farm marketing patterns are heavily weighted towards selling during the fall and winter months. And so if we're still physically shipping massive amounts to China and elsewhere in June, July, August, and we haven't locked in that supply, how do we get it? And so we think this sort of forward basis continues to reach multi-year highs, continues to rally. Because there's still no sign that we're going to slow down exports. We have been competitively priced for really the last 12 months, but now we're seeing forward offers very competitive. This shows Argentine basis is starting to reflect the harvest, but this is an upriver quote. And so you have to take the boat from upriver to the port and top it off. That's about 20 cents a bushel given current rates. So that puts it at parity with the U.S. So U.S. corn and Argentine corn are priced at even money today into Asia for spring and summer delivery. So there's really no definite decision to be made. I mean, it's you could buy U.S. corn or Argentine corn, and we'll see what Argentina's final crop size is, but we think it's going down. But really, we're highlighting in this graphic that there's no competition from Brazil like there was a year ago. The competition from Ukraine is very, very limited given their tight supply situation that they have themselves. And so we don't think that corn export sales slow, certainly not to the point that the USDA will be validated in its current export forecast. Again, this gets much closer to 3 billion bushels over the next couple of months. Because we've had this very unusual growing season in Brazil especially, and one that was somewhat expected in Argentina. This is percent of normal rainfall during the growing season ending January 31st. And so La Nina has been established for several months, and that tends to bode very poorly for rainfall in Argentina. And as expected, we've had major drought and soil moisture loss there. So those crops in Argentina are still overstated. But what's really important to us is this unusual drought that developed across the tropical latitudes of Brazil. These areas are adjacent to the rainforest, yet very limited rain in December, which is the beginning of the wet season, and it really hasn't caught up to normal. Argentina corn specifically, rainfall to date suggests pretty strongly to us a final corn yield 10% below trend, and that is important because the USDA and a lot of the trade in their trade matrices are working with a number 3% below trend. And so this would take off another 4 or 5 million tons from Argentina's crop once it's harvested. And again, because there's no carryover stocks, any demand that represented would have to be shifted somewhere else. Going back to the previous FOB lineup slide, that clearly goes to the United States because we're the only one with somewhat abundant supply at the moment. And unlike last year, Argentina will not be saved by some abnormally wet February. Drought has returned, and this is based on, again, lingering La Nina. So well below normal precip in February. And this is odd for this year specifically because the rainfall in January was better than expected, but didn't really impact crop during critical stages. So the early planted crop in Argentina pollinated in December during a very, very dry period. The later planted crop, because it was delayed, will pollinate in the end of February and early March. And so all the rainfall in January did was provide enough moisture to finish planting. So there's still a lot of concern in South America. These are pictures from our own crop tour of Goiás and Mato Grosso in central Brazil during mid-January. This is not representative of the country as a whole, but is representative of the very dry areas of central Brazil. And obviously those beans look terrible. And so this just shows us that Brazil is not immune to dry weather. We're finding this unusual fungus that has been more widespread than we thought in Mato Grosso and in areas that did not experience drought. Fungus is now also spreading into southern Brazil because it's been too wet over the last 2 weeks. So the weather has been wrong at exactly the wrong times in Brazil throughout the growing season. And now we're dealing with, perhaps more yield aside and weather aside, a timing issue. The crop was planted late. development was slow. Now it's raining too much in the driest areas of Brazil. It's raining at the wrong time during harvest, and so we do get pretty good guidance on crop progress and harvest progress. So as of last week, the crop in Mato Grosso, which is the largest corn and soybean producing state in Brazil, was just 11% complete. A year ago, soybean harvest progress was 45% complete. And so we don't think that soybean harvest will be 50% complete until the very end of February, maybe even the first week of March. And that's important for trade flows in the near term because we do know that there are 10 million tons of vessels waiting to load soybeans in Brazil. This is normally when their soybean export program begins. But those boats are not going to be loaded because harvest is so delayed. And as the vessel lineup grows, demurrage costs grow, and it becomes prohibitively expensive to keep your boat there. And so we think that there will be more demand switched from Brazil to the United States over the next 4 to 6 weeks. And this has a compounding impact on global corn supply and demand because the corn quite literally is planted. The planter rolls right behind the combine in central Brazil. So as they harvest the soybeans, they plant corn right behind it. So of course, as soybean harvesting is delayed, corn planting is delayed. And this winter corn crop now accounts for 70% of Brazil's total corn crop. So it is really the crop that world importers rely on. And so as of last week, that winter corn crop in Mato Grosso, again, the largest producing corn state in Brazil, was only 8% complete. A year ago, it was 40% complete, and probably doesn't reach completion until the second half of March this year, we think. And so we're already delayed in getting that new Brazilian crop. Instead of being in August, the world importers now must wait until September to get Brazil's corn supply. But the real issue arises because of seasonal rainfall patterns in Brazil. So usually if the winter corn crop can be planted in late February, mid-February, you get some of those April rains, maybe those May rains during pollination, but this year the crop will start to pollinate in May. And we know based on all years, the wet season ends entirely in June. And so the odds of that crop being late, harvested anyway, and pollinates during fairly warm but completely dry month of May and June, that bodes very poorly for this crop and for the world trade matrix and for global corn supply. The last year that Brazil's corn crop was similarly late, in 2016, it was also very dry during the spring months there, but the USDA lowered Brazilian corn production by 20 million tons. And so if that were the case, then 10 million tons of demand would be forced to the U.S. And that's demand that all of a sudden we may not have. Or at what price do you get the corn farmer to sell all remaining bushels to maximize exports, but that also draws down U.S. in-stocks to sub 1 billion bushels. And so all of a sudden we're at the supply and demand scenario that matches the 2010 to 2012 period. And we have evidence of how human beings react to corn stocks that tight, and it's $6 plus futures. So again, volatility is the name of the game. It will be a bumpy ride, but everything that we're seeing in the data is still bullish corn. And because of La Nina already, in spite of the normal seasonal risk that exists because Brazil's wet season ends in June, the climate forecast as of now is dry during the spring months. And so all this just creates an uphill battle to maximizing corn production in Brazil, which works in the favor of the U.S. farmer. And this is also being reflected in Brazil's cash market. Again, you can pick any market and they all look very similar. They're all very bullish. But because Brazil has no corn supply available now, their first crop, which is harvested in January and February, lost about 3 million tons from initial estimates. And so they're barely going to make it to bridge that gap between the first crop and the early second crop harvest. And so the domestic market has no choice but to stay very highly elevated. This is $6 plus per bushel in Brazil. So they're not going to be rejoining the export market anytime soon. We think September at the earliest, and that covers the entirety of our old crop marketing year. And there's still really no indication on the big picture sense that global demand is slowing. partially because of China, partially because of food security issues, because of COVID, global major crop trade will be record large in the 2020 crop year. The only thing that changes or balances this out is price, and that's what we've seen the markets, the markets have been doing over the last several months, is digesting this information. The 54 million ton loss in production from initial estimates, China's return to the market because of their soaring pork production and hog herd rebuilding faster than expected, and just generally outside of China, no one's willing to go without food, and so price must go up to reflect the supply and demand scenario. This too, again, I wanted to highlight this because this is where we think that the major corn exporter stocks to use will be in the end, once we digest higher corn exports, higher Chinese corn imports, the loss of South American supply. And so this is just simply on par with 2011 and 2012, which $6 to $7 corn was routine. And so this doesn't happen immediately. And we do need to confirm crop loss in South America, but the numbers, again, are telling us that these psychological resistance levels, $5 first, $6 next, are kind of meaningless in the big picture. So we've got to go to a price that encourages maximum acreage expansion of all crops, slows demand a little bit on the margin, and that's not where the markets are today. And this means that the U.S. corn, soybean, and wheat export will be record large. Share of world trade will be the highest in years, and so this is all very, very positive. And as long as China stays the big driver of world ag demand, the U.S. has a decent foot in the door because of the Phase 1 agreement. We think that China will spend ultimately a little over $30 billion on U.S. products in 2020, and will spend at least in the language $40+ billion in 2021. And because China's need for feed and other products is very real, we think that comes either to fruition or very close to fruition. So the export totals will stay very, very large over the next 8, 10, 12 months. And this doesn't give us any guidance for this particular February WASDE. And these prices are as of January 22, but I just wanted to highlight the curve. And so our stocks to use curve is closer to 7%, and it starts to get very, very steep at that point. So projecting stocks to use at 7% gives you a fair value of 570 plus. And so again, just wanted to highlight that the numbers are still very bullish corn. And in soybeans, we're at a very, very steep part of this curve, in that the USDA's forecast of just under 3% stocks to use is $14 plus futures, which is, I think, why the soybean market has rallied in spite of disappointing export adjustments and a lower close in corn and wheat on Tuesday. But our number of close to 1% gets you close to $16.50, $17. And not that that happens. We don't want to make that necessarily part of the strategy, but we do know that we're moving to the left in this graphic. And so as you move even a little bit to the left from 3 and 2%, it gets very bullish very, very quickly. And again, the only way this is solved is through record crops in the U.S. and across the Northern Hemisphere in 2021. But we're already seeing threats. I mean, the first crop that will be harvested, of course, is winter wheat. Now, drought's intact now, and so that's concerning enough, but because of La Nina and its impact on weather in Texas and Oklahoma, the NOAA, in their latest forecast, is predicting additional expansion in drought, and no change in drought to where it exists now. And so we do get into Nebraska, western Iowa. That drought is expected to persist at least until the early part of summer. And so that demands more rain from the sky if it's not there in the soil. La Nina is now forecast with low confidence, but it's forecast to continue throughout the growing season. And this doesn't mean very much in the case of Nebraska or across the rest of the principal corn belt. But on the margin, it is worse than not having La Nina. It is worse than El Nino. So we do see that yields below trend are more frequent than normal in La Nina summers. So this is something that we'll watch very, very closely. And notice that most of the models in this plume are in agreement that La Nina, to some extent, does persist in 2021. The climate forecast into the end of April, similar. where drought exists now, it will remain. Very wet spring across the Midwest, which could pose problems at planting, which again, there's zero tolerance for any of this. But we're also seeing sort of an atmospheric setup that's promoting drought longer term. And so I wouldn't place much confidence in any forecast details, beyond 30 days, for example, but that this exists at a time when stocks are very, very tight is something that we need to pay very, very close attention to. And in marketing patterns, we need to know what is produced before we make any big time decisions. New crop prices are attractive now, but we want, to plant the seed that weather might be adverse during the summer months. And so keep that in mind as you make forward sales. But then really here's the crux of the issue. So our old crop soybeans in stocks, 50 million bushels pipeline, must have demand rationing. Our domestic use is lower than the USDA, our exports are higher. Demand has to be capped at 4.63 billion bushels. But so if we're only carrying over 50 million bushels, and we assume that harvested area expands by 7 million acres, record expansion, trend yield, lower total consumption next year, we're still left with what is very close to pipeline stocks. And that assumes fairly normal central U.S. weather. 2.2% stocks to use is still $13 to $15 November soybeans. So that market is undervalued. Understandably, no one's focusing on supply and demand now. Most important is the spread that is part of the arsenal that's used to ration supply. But that's the message, is even in the best case scenario, the U.S. soybean balance sheet loosens only fractionally. Corn is not as intense, but is a similar situation. If we're only carrying over 1 billion bushels next year, and this assumes a big Brazilian crop, which I highlighted may not be the case, then assuming acres expand, harvested area expands by 2 million, record yield, slightly lower total consumption, and we're still left with only 1.3 billion bushels next year. This puts upside potential in December 21 corn at 5 to 550. If there are weather problems, we have newer highs and a new part of this bullish cycle. And so that's the message that we have, is that everyone understands that commodities are highly priced now because supply and demand is very tight. But moving forward, even if Mother Nature is kind to us, it doesn't get much better. And so it's going to take, consecutive years of record yields here and in Ukraine and Europe and Brazil and in Argentina to really solve this supply issue. And eventually this, ultra bearish pattern returns because Brazil is going to continue to expand to some extent. China eventually finds a balance between its food production and food imports. But that's not going to be next year. Perhaps the 2022 crop year, but we're still very bullish and very unwilling and reluctant to make new crop sales, even at current prices. And so I thank you for your time as always. And if you have any questions, please reach out to us at Ag Resource. And we're happy to discuss marketing patterns and marketing strategies. And I hope you enjoy the rest of the meeting and have a wonderful night. Thank you.